The United States has just executed one of the largest short-term debt sales in recent history, a move that will impact you, your savings, and the dollar's future, whether you're aware of it or not. The key news: the U.S. Treasury is issuing a staggering $100 billion in 4-week Treasury bills. That's right, just 28 days until maturity. Not 10 years, not 30 years, but a single month. By the time you turn the calendar page, this debt must be refinanced. At first glance, it seems like standard government borrowing. Issue debt, find buyers, keep the system running. But this is no ordinary operation. The massive scale and ultra-short-term nature of this sale reveal a more urgent story. It shows the U.S. government needs cash now and is resorting to emergency-style borrowing to get it. Short-term T-bills are a quick fix, meant for temporary funding gaps. But raising $100 billion this way is like covering your mortgage with a payday loan. These bills mature almost immediately, trapping the government in a relentless cycle of refinancing. Why should you care? The U.S. isn't just any debtor. It issues the world's reserve currency, the foundation of global trade and finance. For years, the ability to borrow freely was a given. U.S. treasuries were seen as the safest bet, and the dollar was untouchable. But things are shifting. Countries are pulling back from the dollar, not because trade with the U.S. has stopped, but due to growing worries about America's ballooning debt, the weaponization of its currency, and the dollar's declining purchasing power. These aren't just theories, they're backed by data. Foreign holdings of U.S. treasuries, especially by major players like China and Japan, are shrinking. Meanwhile, central banks worldwide are stockpiling gold and exploring alternatives. Let's dive into what's happening. When debt matures, you either pay it off or roll it over. Paying it off requires cash the U.S. doesn't have. Rolling it over means issuing new debt to cover the old, plus borrowing extra to plug ongoing deficits. That's the game now, and it's picking up speed. With massive debt maturing, deficits soaring, and interest costs skyrocketing, the U.S. spent nearly $1 trillion last year just on interest payments, a record. That's money not going to roads, hospitals, or the military, but to servicing old loans. Washington's response: borrow more, especially through short-term T-bills. Experts call it a T-bill flood, and while they claim there's no immediate danger, the medium-term outlook is grim if this continues. Relying heavily on short-term debt is like balancing on a tightrope without a net. A sudden spike in interest rates or a drop in investor interest could make refinancing costlier or impossible. Right now, money market funds are snapping up these 4-week bills. That works for the moment, but these funds chase profits. If the Federal Reserve cuts rates later this year, they could pivot to higher-yielding assets, leaving the Treasury scrambling for buyers, likely at steeper costs. This ripples into the broader financial system. Money market funds often stash extra cash in the Fed's overnight reverse repo facility, a liquidity cushion. But as funds pour into T-bills, that cushion is shrinking fast. If it gets too thin, the financial system loses its flexibility. Markets could seize up, banks could face funding issues, and the Fed might have to intervene with emergency measures, often printing more money, which risks fueling inflation. Worse, Treasury officials are hinting this isn't a one-off. Massive short-term borrowing could become routine, setting a risky precedent. Consider this: the UK, a major global economy, plans to issue about $375 billion in bonds for its entire fiscal year. The U.S. is issuing over a quarter of that in just one 4-week T-bill sale, not for long-term growth, but to keep the lights on. This shift to emergency-style financing as standard practice has serious consequences. It limits the ability to respond to real crises, makes the U.S. more exposed to market mood swings, and gives profit-driven private funds more sway over national financial stability. It also fuels doubts about the dollar's long-term strength. The decline of dollar dominance isn't a far-off risk, it's unfolding gradually. The dollar's reserve status once guaranteed demand for treasuries, but as nations diversify into other currencies, gold, and resources, that demand is fading. This forces the U.S. to offer higher interest rates to attract buyers, driving up costs for mortgages, car loans, business financing, and consumer debt. Even if inflation seems under control officially, higher borrowing costs push prices up over time. The speed of this shift is what's most concerning. This isn't a gradual drift, it's accelerating. More short-term debt, growing investor caution, and policymakers doubling down on this approach is like sprinting just to stay in place. Zoom out, and the pattern is clear. Rising debt, surging interest costs, waning foreign demand, shrinking liquidity buffers, and reliance on quick fixes. This isn't the hallmark of a currency at its peak. It's a system leaning on stopgaps over sustainable solutions. The more you roll over debt, the more you're exposed to market shocks. One bad auction, one unexpected rate spike, or one geopolitical crisis could spark a funding crunch. Some argue the U.S. can always borrow by printing dollars, but that risks runaway inflation and erodes confidence in the currency. The more you lean on printing, the closer you get to a point where investors demand higher returns to hold dollars. History shows dominant currencies can fall. Think of the British pound, Dutch guilder, or Spanish real. It's not instant, but once cracks appear, the decline can be faster than expected. The dollar's warning signs are flashing louder than they have in decades. This $100 billion 4-week debt sale isn't just news. It's a sign of a deeper structural issue, a move from stable financing to emergency borrowing as the norm. It's a reminder that the U.S. is on a narrowing path with less margin for error. The bottom line? This isn't just a story for economists or traders. It's about your cost of living, the security of your savings, and the U.S. economy's future. Each massive short-term loan is a gamble that buyers will be there to roll it over in weeks. That bet holds, until it doesn't. When that day arrives, the fallout won't just hit Washington or Wall Street. It'll hit every household, paycheck, and price tag. When your financial strategy hinges on debt due every 4 weeks, you're always one bad month from a new economic reality.